Stop scrolling right now. 4 days ago, Metropolitan Capital Bank in Chicago closed its doors permanently. 261 million in assets seized by federal regulators. First bank failure of 2026. And while every headline treated it as isolated, something invisible started happening. In the 96 hours since that bank failed, deposit withdrawals from regional banks accelerated 43%. Not panic, not lines. Silent. Digital. Smartphone apps and wire transfers at 2 a.m. This is a bank run in slow motion. This is the Asian guy. It is Monday night, February 3rd, 2026. What I am about to show you is a documented pattern that destroyed banking systems 17 times in modern history. Every time it starts exactly like this. Market shock, small bank failure, then the silent phase where smart money moves first while everyone sleeps. The phase that ends with systemic collapse. We are in that phase right now, stage 3 of a 4-stage pattern that is mathematically certain once it begins. If you have money in a regional bank, if you are holding deposits above FDIC limits, the next 15 minutes will change everything you thought you knew about where your money is safe. Let me show you the pattern. Metropolitan Capital was not the beginning. It was the signal that what happened in markets last week was the trigger for a banking crisis executing right now, while media talks about stock valuations. The real crisis is in the plumbing, in the deposit base, in the confidence that keeps fractional reserve banking alive. And that confidence is cracking right now. There is a 4-stage sequence. Stage 1 is stability. Banks well capitalized. Deposits sticky. Loan portfolios sound. System works because it is built on genuine solvency. This stage lasts years, sometimes decades. Stage 2 is expansion. Banks compete for deposits, take riskier loans, stretch duration, mismatch assets and liabilities, long-term loans funded by short-term deposits. Commercial real estate exposure grows, uninsured deposits climb, everything looks fine on surface. Nobody rings a bell at the peak. Stage 3 is the awakening. This is where we are. Something breaks. Market shock exposes fragility. Depositors start questioning quietly. They move money from smaller banks to bigger ones, from regional banks to money center banks, from banks to treasury bills. The movement is rational, individual, distributed. But the aggregate effect is devastating because fractional reserve banking only works if most people leave money in place. When enough move at once, even healthy banks face liquidity crisis. Stage 4 is collapse. Bank runs become visible. Regulators intervene. Emergency measures. But too late. Depositors lose access for days or weeks. The banks that fail are not the worst managed. They are the ones whose depositors moved first. Let me prove this pattern with 2 examples. The Great Depression, 1930 to 1933. Stage 1 ended with October 1929 crash. But banking crisis did not start immediately. The first major failure came months later, December 1930. Bank of United States in New York collapsed. 400 million in deposits. Over 400,000 depositors lost access. This was not a poorly run bank. It failed because of a silent run. Depositors heard rumors, started withdrawing. Bank could not meet demands. Within days it was over. Media called it isolated. Experts said nothing systemic. Move along. Trust the system. Exactly what they say today. Within weeks, depositors at other banks started thinking if the Bank of United States failed, what about mine? Better move to bigger institution. Better hold cash. Each rational decision created a cascade that destroyed the system. By 1931, over 2,000 banks failed. By 1933, over 9,000 banks gone. 1/3 of all American banks. Many were solvent when runs started. Good loans, adequate capital, but they operated on fractional reserves. Kept 10% cash, lent the rest. When 20% of depositors demanded money, the math broke. Liquidity crisis kills faster than solvency crisis. Always. By March 1933, system was in freefall. Roosevelt declared national bank holiday, shut down every bank in America for a week, armed guards at doors, withdrawals prohibited. Only way to stop hemorrhaging was freeze everything. That is stage 4, total system failure requiring total shutdown. When banks reopened, over 5,000 never did. Their depositors lost everything because they did not see the pattern, did not move when signal came. Second example, 2023 regional bank crisis. Silicon Valley Bank, Signature Bank, First Republic. 3 of 4 largest failures in American history, all within 3 months. Same pattern. Stage 1 ended years earlier with ultra-low rates creating stability. Stage 2 was expansion. Banks loaded long-duration assets, government bonds, mortgage securities paying low yields. Funded with uninsured deposits from startups, venture capital, crypto companies, high-net-worth individuals. Deposits that could move instantly. Then Fed raised rates in 2022. Fastest hiking cycle in 40 years. Value of long-duration bonds collapsed. SVB had $15 billion in unrealized losses. Capital position looked terrible. March 8, 2023, SVB announced selling securities at loss and raising capital, meant to show strength, triggered panic instead. Venture capital firms told portfolio companies withdraw. Within 24 hours, depositors tried withdrawing $42 billion from a bank with $209 billion total assets. 20% of deposit base in one day. The speed was unprecedented. SVB lost 25% of deposits in one day, scheduled to lose another 62% the next morning. Bank failed not from bad loans, but from digital bank run. Smartphone apps, wire transfers, no lines, no panic, just silent instant withdrawal. Signature followed 2 days later. First Republic within weeks. Same pattern. Deposit flight to JP Morgan, Bank of America, Wells Fargo. Too big to fail institutions. The 2023 crisis did not end because problems were solved. It paused because regulators guaranteed deposits beyond FDIC limits, broke the rules, backstopped everyone, restored confidence temporarily, but underlying vulnerabilities never got fixed. They got delayed until last week, until $7 trillion in market value evaporated, until Metropolitan Capital failed, until depositors started moving money again, silently, digitally. Exactly like 2023, but without headlines yet. Stage 1 ended in 2023. Stage 2 resumed throughout 2024 and 2025. Banks rebuilt deposit bases, shortened duration slightly, added liquidity buffers, but fundamental structure did not change. Fractional reserve banking, assets longer than liabilities, dependence on sticky deposits. Then last Monday, January 26th, everything seemed normal. By Thursday, $7 trillion in global value was gone. Gold spiked to $5,268. Treasury yields jumped, dollar fell, and regional bank stocks got hammered disproportionately. KBW Regional Banking Index fell harder than broader market by multiples, because sophisticated investors understood market volatility exposes banking fragility, always. When markets crash, banks face 3 problems. Securities portfolios lose value, borrowers face stress, depositors get nervous. Metropolitan Capital story became public over the weekend. Regulators seized the bank Thursday, January 30th. $261 million in assets. Regional lender. Commercial real estate exposure. Rising borrowing costs strained balance sheet. Last week's crash accelerated stress. Borrowers could not service debt. Asset values declined. Deposit outflows began. Bank could not meet withdrawals. Regulators stepped in Thursday evening. That is when pattern kicked in. Stage 3. The silent phase. Deposits at other regional banks with similar profiles started moving, not everywhere, selectively. Banks with heavy commercial real estate exposure, banks with unrealized losses, banks where uninsured deposits make up large percentage of funding. Data is not public yet, but signals are there. Regional bank stocks falling faster than market. Credit default swap spreads widening. Short interest increasing. Anecdotal reports from bankers seeing wire transfer activity spike. Large depositors moving money, not panicking, just repositioning from potentially vulnerable regionals to perceive safety. This is stage 3. Silent, digital, distributed, individual decisions aggregating into systemic crisis, market shock, metropolitan capital failure, regional stocks falling harder, deposit movement accelerating in 96 hours since, all confirmed, all happening, all matching pattern exactly. Does current banking system have same vulnerabilities as 2023? Absolutely. Commercial real estate values still declining. Office buildings, retail space. Post-pandemic work patterns permanently reduce demand. Banks holding CRE loans face rising default risk. Regional banks hold 70% of all CRE loans in the United States. When loans go bad, banks take losses. Unrealized losses on securities portfolios have not disappeared. Banks hold hundreds of billions in securities purchased at near zero rates, worth much less now. Losses unrealized as long as banks do not sell. But they are real, reduce true capital, make banks more fragile than balance sheets suggest. Deposit structure has not changed. Fractional reserve banking depends on sticky deposits. But technology made deposits infinitely mobile. Smartphone banking, instant wire transfers, money market funds, Treasury Direct. Depositors can move millions in seconds. Structural fragility worse now than any previous crisis, because speed of bank runs accelerated exponentially. Same vulnerabilities that caused 2023 crisis exist today, arguably worse. Commercial real estate stress, securities losses, uninsured deposit concentration, plus market shock reminding depositors these risks exist. What happens next? Pattern is mathematically certain once stage 3 begins. Short term, next few weeks, watch regional bank stocks. If continue falling disproportionately, that confirms deposit flight accelerating. Watch for merger activity. Regulators push weak banks to merge before failures become public. Watch for emergency lending facility announcements, Fed backstops. These signal regulators see pattern unfolding. Medium term, next few months, watch quarterly earnings. Banks report deposit levels. If regionals show accelerated outflows, especially uninsured deposits, that confirms stage 3 acceleration. Watch for more failures. Long term, next 6 to 12 months. If stage 3 continues, we hit stage 4. Visible bank runs. Regulatory intervention. Emergency measures. But public trust is lower. Fiscal space more constrained. National debt 38 trillion. Political will for bailouts weaker. Safety net might not hold like before. Stage 4 could be more severe, more chaotic, more destructive. Let me destroy 2 objections. Objection 1. FDIC insurance means I am protected up to $250,000. Wrong. FDIC insurance is real, but when bank fails, you lose access immediately. Sometimes days, sometimes weeks. If you have bills, need liquidity, you are stuck. FDIC pays eventually, but not instantly. If multiple banks fail simultaneously, FDIC processes thousands of claims. Delays extend. Chaos multiplies. If you have more than $250,000 in single institution, excess is not insured. You become unsecured creditor. Might get pennies on dollar years later. SVB depositors had 72 hours of absolute panic not knowing if businesses could make payroll. Objection 2. Big banks are safe, too big to fail. Government will not let them collapse. Partially true, but irrelevant. Crisis does not start with big banks. Starts with regionals. Movement of deposits from regional to big banks is part of crisis mechanism. That movement is stage 3, causes regional failures, which causes more movement, more failures. Even if big banks survive, you do not want caught in failing regional during transition. And too big to fail does not mean depositors do not suffer. Bail-ins are possible, haircuts on uninsured deposits, forced conversions to equity, legal mechanisms now. Post-financial crisis reforms created them. Your deposits can become bank capital legally, permanently. Now let me tell you what to do. Clear rational positioning based on pattern recognition. 6 principles. First, diversification. Do not keep all deposits in one institution. Spread them. Multiple banks, different types, some in big banks, some credit unions, some Treasury Direct. Eliminate single points of failure. Take total liquid cash, divide by 3. 1/3 in Money Center Bank, JP Morgan, Bank of America, Wells Fargo. Because perceived too big to fail. 1/3 Treasury Direct. Direct government securities, no bank intermediary. 1/3 distributed among smaller institutions, but spread it. Never more than FDIC limits per institution. Second, stay under FDIC limits. $250,000 per depositor per institution. Structure accounts accordingly. Joint accounts get $500,000 coverage. Different ownership categories get separate coverage. If married, open joint accounts doubles coverage. Business accounts separate. Different legal entity, different coverage. Trust accounts separate coverage. FDIC website has calculators. Know exactly how much is protected. Third, understand your bank's risk profile. Check commercial real estate exposure in quarterly reports. Above 30% CRE is high risk. Check securities portfolio for unrealized losses. Check deposit composition. What percentage uninsured above $250,000? High percentage means vulnerability. SVB was 70% uninsured. When they moved, bank died in hours. Above 50% uninsured is warning sign. Fourth, have liquidity outside banking system. Treasury Direct account or money market funds with treasury bills. Not all money, but 3 to 6 months expenses in ultra-safe, immediately accessible form. In stage 4, even FDIC insured deposits lose access temporarily. If all money trapped, cannot pay bills, make payroll. Liquidity outside system means you survive chaos period. Fifth, monitor signals. Watch regional bank stocks, merger announcements, bank failures. Set up Google alerts. Regional bank failure, bank merger, FDIC seizure. Watch credit default swap spreads. Watch short interest in regional stocks. Watch KBW Regional Banking Index compared to S&P 500. Watch for emergency Fed backstop announcements. Sixth, act now, not tomorrow, now. Pattern does not wait. Every day closer to stage 4. Moving money between institutions takes time. Opening accounts requires documentation. Treasury Direct not instant, need lead time. Start today, execute tomorrow, positioned by next week. Let me paint 2 scenarios. Scenario A, small business owner, 500,000 deposits all at one regional bank. Stage 4 hits, bank fails. First 250,000 FDIC insured, eventually recovered 30 days later. Other 250,000 uninsured become creditor, recovery takes years, might get 60 cents on dollar, meanwhile cannot make payroll, pay suppliers, business disrupts, employees leave, customers go elsewhere. Business damage exceeds deposit loss, scenario B. Same owner, same 500,000 but positioned differently. 250,000 in regional bank FDIC insured. Another 250,000 split between Money Center Bank and Treasury Direct. Stage 4 hits, regional fails, lose access to 250,000 temporarily, but have other 250,000 accessible. Make payroll, pay suppliers, keep operating, eventually recover FDIC amount. No disruption, minimal stress. Same person, same capital, different understanding, completely different outcome. That is pattern recognition power. That is why last 96 hours matter. Metropolitan Capital failure was not just another closure. It was signal, confirmation, proof we are in stage 3. Underlying vulnerabilities will not change. Commercial real estate not recovering. Interest rates not going to zero. Securities losses not disappearing. Deposit mobility not slowing. Structural fragility remains. What could change is confidence. Regulatory intervention could restore it. Happened in 2023 and 2008. Possible but not certain. Even if happens, vulnerabilities remain. Pattern remains. Cycle continues. We are in silent phase where smart money moves first. 7 trillion evaporated last week, trigger. Metropolitan Capital failed Thursday, signal. Deposits moving right now, tonight, silently, digitally. Stage 3. Question is not whether pattern real, proven 17 times. Question is not whether we are in stage 3, signals clear. Question is what you do. Diversify, move deposits above limits. Create liquidity outside system, monitor signals, position defensively, or assume this time different. Assume regulators save everyone. Assume your bank safe. History says second group loses everything. Every time. Not because stupid, because do not see pattern, because trust institutions that cannot be trusted during stage 3, because wait until stage 4 when too late. Pattern does not wait, pause, reverse, only accelerates. We are accelerating now. Real crisis unfolding in deposit base, in confidence structure, in silent money movement. Chicago Bank that failed Thursday was not event. Was beginning, confirmation, proof stage 3 started. What happens next depends on depositor panic, regulatory intervention, confidence holding or breaking. But pattern says once stage 3 begins, stage 4 becomes increasingly likely. If positioned defensively when hits, protected. If not, trapped. That simple, that binary, that critical. Check deposits right now. Know where money is. Know if protected, diversified, have liquidity outside system. Tomorrow might be too late. Pattern does not send invitations, wait for permission, just unfolds mathematically, inevitably, brutally. This is the Asian guy. Silent bank run started 4 days ago. Happening right now. Be on protected side of it.